Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, good morning, everyone. Good morning, everyone. So, a lot of people ask me, says Mars, whether the week 4 workshop or tutorial will be part of the mid-semester test. I said in the announcement, I said materials from week 1 topic to week 4 topic will all be examinable except for option trading strategy. Then the only thing you have to do is simply ask yourself whether workshop 4 is part of week 4 topic. If it does belong to the week 4 topic, then yes, it is examinable. But only the option trading strategy part of that will not be examinable, right? So the same question applies to the tutorial. Is week 4 topic tutorial part of the week 4 topic? If yes, then of course it's examinable. Only the option trading strategy part of that is not examinable, right? So if you ask yourself those two simple questions, then the answer is very clear. All right? Okay, so this week we're going to talk about binomial option pricing model. Okay, so we have a lot to go through today. If we cannot finish the whole lecture, I will move the binomial pricing for the American option to the workshop this Thursday. Okay? So from previous weeks, we are able to show that the ability to replicate payoff to a derivative contract allow us to work out the fair price of the option, right? And also, this is known as the arbitrage-free valuation. So arbitrage-free valuation gives us the equilibrium price, aka the correct price. So we replicate forward contract and future contract payoff by using a strategy called borrowing some money, then buy the underlying asset. And the big question today is whether we can replicate a call option. The short answer is yes, we can. We can use the underlying stock plus a risk-free bond to replicate payoff of a call option. All right? Again, this is a two-piece portfolio. But before doing that, we need a model to model how share price move over time. Okay? So the binomial model is simple and amazingly powerful. We can use the binomial model to price pretty much anything in the market that we wanted to price. And it is widely used in the industry. So for anything that is beyond the basis of European put and call, then the binomial approach is the only approach that we can value this derivative contract. All right, so if we call today time 0, all right, so just imagine present time, time 0. And option will expire on time t, all right? And we need to model how the share price move from today to the date of expiration. So Black-Scholes used the continuous time stochastic differential equation to model the stock price movements. Thankfully, we are going to use a much simpler model. So the binomial model is much simpler. So we need to model how share price move from today to time t, and we will assume the share price follow a multiplicative binomial process over discrete period. Okay? So if we start with today's share price S, and I'm going to say in 1 period's time, the share price will take one of the two values, right? So the share price will either go up or going down. I'm being a bit vague here. I'm just saying 1 period's time. And you'll be thinking, what do I mean by that? Do you mean 1 day, 1 month, or 1 year? So I'll keep that a little bit vague for the time being, and I'll come back to the definition of time period in the future slides. So that's essentially what the binomial means, right? So the binomial simply means there's only two outcomes can occur. If you think about the share price, Really, share price can only going up or going down, right? So two outcomes can occur. If that's the case, then we can use the binomial model to model the share price movement through time. So that's the whole idea behind today's lecture. All right, so it's all very vague. I'm just saying the share price would either go up or going down. But how much does it go up to? If the share price going down, how much does it go down to? Right? So the next thing we need to do is we must be able to quantify the magnitude of going up and going down. All right, so the way we're going to get the share price in the up state and the way we're going to get the share price in the down state is by taking the initial share price, S. Remember, the share price start today, the spot price is S. Then we're going to multiply that by the proportional increase and proportional decrease. So I'm using this lowercase u. This little u here denotes the proportional increase. U is going to be a number that's bigger than 1. For example, if I say the share price will increase up 10%, then this little u will be 1.1. So 1 plus 10%. Then we take the current share price, S, multiplied by 1.1, we will get the share price in the up state. All right? And similarly, the little u, the little d, the lowercase d is going to be the proportional decrease. All right? And the d is going to be a number that's smaller than 1. If I tell you the share price will go down by 20%, then the d is going to be 0.8. All right? So 1 minus 0.2 give you 0.8. Then you take the current share price, you multiply by 0.8, you will get a share price in a down state. Does it make sense? So we're just going to take the current share price, we multiply by the proportional increase and a decrease, we will get share price in two different states. So that's what I really meant by multiplicative, all right? Okay, so here I'm giving you one example. Imagine we have a stock. The stock price today is $10. And the risk-free rate is 5% over next year. All right, so the time period I mentioned in the earlier slides, here I define one period is 1 year. In 1 year's time, the share price would either go up 35% or the share price will decline by 26%. And you see the way I express the little u is simply 1 plus 0.35. And the way I express the little d is simply 1 minus 0.26. So that's the proportional increase, proportional decrease. Okay, and I mentioned the delta t is the length of one period, which is 1 year. Okay, so basically, we're going to value a European call option with strike price of $7 and 1 year to expiry. Right? So we're given the information about the underlying share price, and we're given the information on the strike price of this call option, and we're also told the expiration date for this call option is 1 year. So the way I'm going to draw this binomial tree is I'm taking the current share price. So you see the current share price is $10, and I take that $10, I multiply by the proportional increase, 1.35, and the share price will move up to $13.50. So when the share price increases, in 1 year's time, the share price will grow to $13.50. Okay? And similarly, if the share price is going down, it will go down by 26%. So I simply take the $10, I multiply by 0.74, and I will have a share price end up being $7.40 in 1 year's time. Okay? So only two events can occur, either going up or going down. When the share price going up, it will going up to $13.50. When the share price decline, it will decline to $7.40. So simple as that, just one step binomial tree. And then, remember, we need to value a call option. So we have a European call option with strike price of $7. So imagine if the share price increased to $13.50, Shall we exercise this call? If the share price increased to $13.50, shall we exercise this call option? Yes, right? Because the final spot price is higher than the strike price. Final spot price is $13.50, higher than the strike 7. If you exercise this call option would make a payoff of $6.50, right? So that's $13.50 minus 7. That gives you a payoff of $6.50. Now, if the share price going down to $7.40, shall we exercise this call option? Yes, because $7.40 is still higher than the strike price 7, right? If we exercise this call option, that would make a payoff of 40 cents. So I simply write the payoff of the call option if the share price increase, that's $6.50. If the share price going down, I write in the payoff on this call option is 40 cents here. All right, so that's going to be our simple model. Not only we need to model the share price going through time, but also we need to understand how bond price, changes over time. So the way we're going to see the bond price is we're going to think that as a bank account, risk-free bank account. All right? Just imagine if you deposit $1 in that risk-free bank account, over 1 year's time, that $1 will grow to 1 multiplied by e to the minus to the power of r times the delta t. Right? So that's initial value, $1 that you deposit in a risk-free bank account. That is the ending value. Alternatively, we can think the bond price evolution as you bought a zero coupon bond. Right? So the way how zero coupon bond works is you pay the present value of the zero coupon bond, and in 1 year's time, this zero coupon bond will pay you the face value. Right? So simple as that. So the bond is very simple because the bond is a fixed income security. As the name suggests, irrespective of the market situation, the bond will always pay you a fixed payoff. All right, so if we understand that, then I'm going to introduce you the first approach. The first approach is called replication approach. Our task here is to replicate the payoff of a call option. Okay? So in today, time 0, we're going to construct a two-piece portfolio that replicate the payoff of a call option. And this two-piece portfolio involve, invest some money in the underlying share and invest some money in a risk-free bank account. So let me be more precise here. We're going to buy delta amount of shares. So delta measures how much share we need to buy. All right, we're going to buy delta number of shares, and we're going to invest $B in the bank account. So $B is the amount that we're going to invest in a risk-free bank account. And we're going to cleverly choose delta and B so that the value of the portfolio, the ending value of the portfolio, mimics the payoff of the call option. So let me just say that again. We're going to carefully choose the amount of delta, and we're going to carefully choose the amount of B so that the ending value of our portfolio matches the payoff of the call option in 1 year's time. If we can successfully replicate the payoff of the call option, then the construction cost of this portfolio must equal to the price of the call option. Right? You guys know the drill. We did this last week. If we can match the payoff of the call option by using this portfolio, then the setup cost of this portfolio must equal to the call option price. If that doesn't equal, then there's an arbitrage opportunity. Right? Just bear that in mind. So everybody clear what we're going to do next? We're going to invest delta money in the share, invest $B in the bank account, and we're going to carefully choose delta and B so that the payoff of the portfolio equal to the payoff of the call option. That's what we're going to do. Okay, so I'm just going to give you these two formulas here. You don't need to know much about these two formulas. You don't need to know how to derive them. You just need to know how to use them. Okay, so basically what this delta measures is the changes in the call option price with respect to the changes in the underlying share price. All right, so in the numerator, it measures the difference between the call option payoff and the call option payoff in the downstate. So let me say it again. So in the numerator, this thing here is the call option payoff in the up state when the share price ends up being high. And the C with subscript D denotes the payoff of the call option if the share price declines. What's in the denominator is the difference in the share price between the up state and the down state. All right? And the B measures how much money we need to invest in the risk-free bank account. We have all this information, right? Going back to the tree, we know that what the share price is going to be if in the up state, we know what the call option payoff is going to be in the up state. And also we know the corresponding value of the share price and the call option payoff if the share price going down. Now, if the share price increased to $13.50, then our call option is going to make a payoff of $6.50. Remember, just refer to the diagram. If the share price going down, decline to $7.40, then our call option will make a positive payoff of 40 cents. So that's the difference between the two. And that's the difference between the share price. And we work out the delta is positive 1. Now, if the delta is positive 1, it simply means we need to buy 1 unit of share. Okay? So if the number come out to be positive, that means we need to take a long position. We need to buy 1 unit of share. I don't want you guys to think the delta would always be 1. Delta can be any number. It's just the coincidence that delta equal to 1 here. Okay? And then we'll work out the B amount in the bank account. So the U and the D is simply the proportional increase and the decrease, and that's simply the payoff from the call option in the down state and up state. Okay? Then we also know the risk-free is 5%. We know the delta T is 1 year. And we work out is negative $6.65. What does negative $6.65 mean? If positive value means we invest, negative value simply means we're going to short, right? We're going to short this risk-free bond. Shorting also means borrowing. So if the number come out to be negative, that means we need to borrow $6.65 from the bank. And we're going to repay the risk-free interest expense. Does that make sense? If it's a positive value, that means we're going to take the long position in the riskless bond. If it's negative value, that simply means we're going to short the bond, which means we're going to borrow $6.65. Okay, so our strategy here is to buy 1 unit of share and then borrow $6.65 from the bank. And let's see whether the payoff of this portfolio would match the payoff of the call option. All right, so in 1 year's time, let's check the ending value of our portfolio. Now, in 1 year's time, the share price will increase from $10 to $13.50 if the share price rises, right? Now, and we own 1 unit of that share, so that's 1 multiplied by $13.50. At the same time, we also need to repay the loan that we borrowed, right? So 1 year ago, we borrowed $6.65, and 1 year later, we need to repay $6.65 with a bit of interest. So that's $6.65 times e to the power of 5% multiplied by 1. And the negative sign simply means we need to repay that money, the money going out. Right? So if you sum up these two values, if the share price increase, the value of our portfolio is simply going to be $6.50. Yes? Everybody understand this? Now, if the share price decrease, the share price will decrease to $7.40. And we own 1 unit of share. So that's 1 multiplied by 740. And again, we need to repay the loan that we borrowed 1 year ago. Right? And it turns out when the stock price decreases, our portfolio has an ending value of 40 cents. It looks very similar, right? Because the payoff in our portfolio is identical to the payoff of the call option. Remember, when the share price increases, the call option pay out us $6.50. When the share price decreases, this call option pay us 40 cents, right? And check our ending value for the portfolio. When the share price go up, the portfolio end up with $6.50. When the share price going down, the portfolio value end up with 40 cents. The payoff of the portfolio is identical to the payoff of the call option. Then what's next? Then the construction cost of our portfolio must equal to the price of the call option. Yes? Because the portfolio is equally good as the call option. So the construction cost of this portfolio must equal to the call option price. If they don't equal to each other, then there's arbitrage opportunity here. All right, so let's check how much we entered into this portfolio. Remember, we bought delta unit of share, and each share cost us $10, right? So that's 1 multiplied by 10. And also we borrowed $6.65. So the net cost to construct this portfolio is $3.34. So this $3.34 must be the price of this call option. And it's also known as the arbitrage-free price for the call option. Does it make sense? Yes? What is the purpose of minus the bonds? So this slide, 16. Yes? Yeah, so that's us repaying the loan. So you're asking why we need to borrow some money from the bank. Yeah, we short the bonds. So going back here, the B came out to be a negative value. So negative value means we need to place a negative weighting in the bond. The way we're going to construct negative weighting is by shorting the bonds, by borrowing some money at a risk-free rate. Now, 1 year later, we need to repay that money. So that's the money going out. Yes. So that's the share price minus $6.650 times e to the power of 5% multiplied by 1. Yeah. Yeah. So everybody understand this concept? We managed to replicate the payoff of a call option, then the setup cost of the portfolio equal to the call option price, $3.34. Any question on the replication approach? Okay, so one interesting point. If you flip back to slide number 10, remember I told you that there was 30% probability the share price will go up and a 30% chance the share price will go down, right? Although I give you that information, but we did not use that information to price this call option. If you look through all the calculations, nowhere I had to use that probability, right? The 70-30 probability never get used as the input for us to calculate the call option price. Just bear that in mind. We don't need to use the actual probability. And then later on, we're going to take that advantage and introduce something called risk-neutral pricing. Okay, just bear that in mind. Okay, so the next approach I'd like to introduce to you guys is called delta hedging. Okay, so delta hedging is quite similar to the replication approach. Now the difference is here. We're going to invest in delta amount of shares. So the first piece to that strategy is identical to the replication approach, right? So in the replication approach, we invest delta money in the shares and we borrow the B amount of money from the bank account. But instead of using the bank account, this time we're going to short the call option. So we're going to short 1 unit of call option, then buy delta shares. But why does this approach called delta hedging? So if you think about call option writer, right, somebody who short in a call option, they are exposed to extreme downside risk, right? Because in theory, there's no upper limit as to how much the share price can increase to. So whoever on the long side of the call option, if the option becomes in the money, whoever on the long side of the option can exercise against the shorter of the call option, right? And because the share price has no upper limit, that means whoever on the short side of the call option has a downside risk that is virtually unlimited. Does it make sense? Does it make sense? If you shorten the call option, that means you have unlimited downside risk. Because to the call option holder, they have unlimited gain, right? Because there's no ceiling as to how much share price can increase to. Then you must ask yourself, how does the writer of the call option protect themselves? Have you ever thought about this question? If somebody short a call, how do they protect themselves? Now, the writer of the call option will use the strategy called delta hedging approach. Now, the way is very simple. After you shorting the call option, after you sold this call option to somebody else, you need to buy delta amount of shares to hedge the downside risk, right? Because if the share price increase above the strike price, if the holder of the call option exercises against you, you don't have to worry because you have delta amount of share in place that's ready to be sold to the holder of the call option at a strike price X, right? You are fully hedged because you get yourself prepared for the scenario that the holder of the call option will exercise against you. Does that make sense? So that's the whole idea behind delta hedging. You short 1 unit of call option, then you buy delta shares. Okay? Then again, this is a two-piece portfolio. We're going to use the V subscript U denote the value of this portfolio in the up state, and we're going to use the VD to denote the value of this portfolio in the down state. All right? So look at this one-step binomial tree. Now, if the share price increased to $13.50, the call option would make a payoff of $6.50. But because this time we short the call option, it is a negative $6.50 to us, right? Because the holder of the call option make a payoff of positive $6.50. That means we lose $6.50. So that's negative $6.50. And if the share price decrease to $7.40, whoever on the long side of the call option make a positive payoff 40 cents, we lose 40 cents. So that's negative value in front of the 40 cents. Okay, so let's check in 1 year's time, what is the ending value of our portfolio? Remember, we bought delta shares. The delta is 1, right? We calculated the delta before. The delta is 1. So 1 multiplied by the share price, $13.50. And because the call option is in the money, and the holder of the call option exercises the call option, we lose $6.50, right? So that's the minus sign in front of $6.50. That means we lose $6.50. So the ending value of the portfolio is $7. Now, if the share price going down to $7.40, so that is the value for our share. And again, we lose 40 cents on this call option. So the net ending value for the portfolio in the down state is also $7. So what does it mean? It means that our portfolio act like a riskless bond, right? Because our portfolio would always make a fixed payoff, $7 in respective of the share price movements. Regardless of the share price going up or going down, the portfolio would always end up with the same value, $7. So I would argue this portfolio is identical to a zero coupon bond, right? It's riskless. It would always have a constant ending value in respective of the market state. So if we can understand that, then we know how to value the zero coupon bond, right? How do we value zero coupon bond? We're simply discounting the face value of the zero coupon bond back to the present using the risk-free rate, right? So that's how we value the riskless zero coupon bond. So we can do the same thing to our portfolio. Our portfolio would always end up with $7, and we can use the risk-free rate because it's riskless. It would always have $7 in respective of the market movement. We discount back 1 year using the risk-free rate, 5%, and we get the present value of this portfolio is $6.65. Does it make sense? All right, so we know how do we construct this portfolio. So we bought delta unit of share, and we short a call option. So what do we know about the portfolio? The portfolio has a present value of $6.65, and the current share price is $10, right? We have these two information. Then what we can do is we can simply rearrange this equation to back out the price of this call option, right? So if we rearrange this equation, the call option is simply equal to the delta S minus the present value of this portfolio. So the current share price is 10, the present value of the portfolio is $6.65, and we work out the call option price is $3.34. Same answer as we got under the replication approach. Does it make sense? Let me reiterate what we have done here. First of all, we construct a portfolio that is riskless. Then we discount the portfolio value back to the present, and then we take the current share price, we back out the call option price has to be $3.34. And we got the same answer as we got under the replication approach. So any question with the delta hedging approach? Does it make sense, the delta hedging approach, how we got the call option price? Yes? If you have any question, you can just ask me now. Okay, so if we can understand the replication approach, yes? $22, yeah. Yes. Yeah, so exactly. So this only works for one-step binomial tree, right? And as we understand, if we divide this into infinite intervals, we have thousands and millions of steps. Then we need to recalculate the delta on every step so that we always have a fixed ending value. Yes, a very good question. So he asked that I set up the question so that the share price will decrease to $7.40 so that we have ending value of 7. What if the share price decreases to 6? Then we need to do the whole process all over again to work out what's the delta and to work out how much call option to short. Then we get an fixed value. Okay, so this is a very rough modeling of the share price because what is going on with our simple binomial modeling is there, 1 year to expiry and there's one step in the tree. Now later on, I'm going to show you more sophisticated modeling, so we're going to have 2-step and 3-step. More step in the tree, that means more accurate modeling of the share price, and which means we will get a more accurate call option price. Okay? So this is just introducing the idea using a simple and a rough binomial tree, one-step tree. So any other questions before we move on to risk-neutral approach? Yes? Yeah, so we're going to have a whole lecture in week 8 to talk about delta hedging, the hedging ratio. All right? So for today's lecture, we're simply going to borrow the idea of delta hedging to introduce the risk-neutral approach. All right? So we're going to come back that later in the future weeks. Hedging ratio. All right? So any other questions? All right, good. So if we can understand the replication and delta hedging, then I will introduce the third approach to value the call option. And this third approach will give us the same answer. So in the industry, most of the derivative contract is priced use risk-neutral approach. And you might ask why we cannot use the traditional approach to value the options. The short answer is yes, we can use the traditional approach, but no one in the industry use the traditional approach. Why? Because they are very complicated and they are very tedious. So let me demonstrate how traditional approach work, and then I'm going to convince you that nobody wants to use traditional approach because it's time-consuming, it's tedious, and we have a much simpler approach called risk-neutral. We can get the same answer. All right, so remember how traditional approach works? The traditional approach is that in the foundations of finance, first of all, you will draw a timeline. Then you will schedule the future cash flow at each point in time. Then what you do is you estimate a discounting rate using the capital asset pricing model. Then you discount all the cash flow back to the present, right? So that's the way how we get the present value. That's the way how we value the stock, we value the projects, and we value companies. So that's called a traditional approach. And effectively, we can do the same thing to our call option, all right? So here is the timeline. We have 1 year, and we know the ending value, right? So the share price, if the share price go up, it end up with $13.50. If the share price go down, it will end up $7.40. And we know the probability of going up is 70%. The probability for the share price to go down is 30%. So if we know the probability, we know the terminal value, then we can work out the probability weighted average of the share price. We can work out the probability weighted average of the option payoff, right? Then we can discount back 1 year to get the present value of the call option. And that has to be the call option price. So that's called traditional approach. Okay, so with traditional approach, we need to know several things. The first is the timing. Timing is trivial because we're dealing with the European option here. So all of the cash flow will happen at the maturity date, right? So we know the exact point when the cash flow will take place. And also we know the magnitude of expected payoff, right? So when the share price increased to $13.50, the option pays us $6.50. When the share price decreased to $7.40, the option make a payoff of 40 cents. So that is the probability of those two events happening, and we can work out the expected option payoff is $4.67, right? So that's what we learned from Foundations of Finance. Then all we need to do, just watch this mouse here, so we can discount the $4.67 back 1 year, right? Then we can get the call option price. But then, one thing we need to do is we need to estimate the discounting rate. We need to know what is in the denominator to discount back $4.67 in order to get the present value of this call option. And that's where the thing's getting a little bit ugly, because it turns out it's extremely tedious to estimating the discounting rate to discount this call option. All right, so here I give you the formula to estimate the discounting rate that discounts the call option payoff. So basically, the discounting rate is the expected rate of return on this call option. And expected rate of return on the call option should equal to the risk-free rate plus a premium, right? Because call option is a risky asset. If you invest in the risky asset, you should be compensated at least by the risk-free rate. So that's the first bit. That's the risk-free rate. And then plus a little bit extra. because this is a risky asset, right? And this premium, the way the premium works is that it's the difference between the stock return and the risk-free rate, then multiplied by this omega. So this omega measures the elasticity of changes in the call option price with respect to the changes in the underlying share price. So this formula looks very similar to the capital asset pricing model. Do you guys remember? Because the capital asset pricing model is the expected return on the stock equal to the risk-free rate plus the beta, then multiplied by the market premium. So the market premium is the difference between the market return and the risk-free return. Okay? So we know what the risk-free rate is. We can observe that from the market. And we also know what is the expected stock return. How do we work out expected stock return? So when the share price increased from $10 to $13.50, that represents 35% return, right? When the share price decreased from $10 to $7.40, that represents negative 26% return. And we know there's 70% chance the share price going up and 30% chance the share price going down. And we simply take a probability weighted average, we get the expected return on the share is 16.7. 16.7% expected return on the stock. Does that make sense? Okay, so we get the share price return, and the next thing we need to do is to calculate this omega. So this omega measures the elasticity, as I mentioned before. Well, this omega starts off with a very ugly formula here, but if you rearrange this equation, this whole omega equation would boil down to this stuff here, which is simply the share price divided by the call option price multiplied by delta. But wait a sec, the whole point of doing this exercise is to work out the call option price, but then in the omega formula, the call option price becomes the input to calculate the omega, right? So that's a bit of funny here. But that's okay. So we know the share price is $10, and we calculate our delta before. Our delta is 1, and we simply leave the call option price there as an unknown variable. Okay? So that would become our omega. So we will leave the C as an unknown variable for the omega, and we will carry this over to the discounting formula. And then we have one equation and one unknown. We can back out what the call option price is. So first of all, does everybody understand this will be the discounting rate? Does that make sense to everybody? So this is the discounting rate that we're going to use to discount expect payoff. So we'll work out expect payoff on this call option is $4.67, and we're going to use this discounting rate, so this entire equation, to discount $4.67 back to the present. So let's do that. So that is the expect payoff on the call option, $4.67, and that is our discounting rate, right? Because we don't know what the call option is, we simply leave that as an unknown variable, and that would equal to C. So we have one equation and one unknown. We can solve for the C. So if you go home, rearrange the equation, you can solve that. The C turns out to be $3.34, right? So exact same answer as we got from the previous replication approach as well as the delta hedging approach. Now, if traditional approach works, why nobody use it in the industry? Well, although this omega formula look a little bit ugly, but that is not the main reason that people are not using it. Because omega, if you're going back to the previous slide, omega is a function of the share price, right? If that's the case, that means every time when the share price changes, we need to re-estimate this omega. And we need to solve for the C, right? It's a pain in the neck. It's very tedious. Now, if we want to have a very accurate modeling of the share price, then we're going to add more steps to our binomial tree. So here I'm just showing you the 10-step tree. Now, with the 10-step tree, which means at each branch, we need to re-estimate omega. And at each branch, we need to solve for the C. So that is a lot of computational burden that we need to deal with. So that is the main reason that no one uses this traditional approach in the industry to value call option or put option. Okay? So given it's never get used in the industry, yes. 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 Yeah. It shouldn't depend on the probability. Very good point. So it turns out that people figured this out in early 70s, that we never need to use probability to work out the correct call option price. So next, what I'm going to show you is I'm going to plug into ROM probabilities, and we will still get the same answer, $3.34. All right? Let me say this again. 70% chance going up and 30% chance going down is completely irrelevant for pricing call options. Call option price does not depend on the probability. And I'm going to convince you by plugging into the ROM probabilities. Okay? So what if I plug into 60 and 40 probability? Remember, our correct probability was 70% chance going up and 30% chance going down, right? So let's just pretend that there's 60% chance going up and 40% chance going down. So we can recalculate the payoff from the call option. It turns out to be $4.06, right? And we can recalculate the expected payoff on the, expected return on the stock. That's 10.6%. And then again, we can solve for the C, and it turns out we get the correct call option price, $3.34. And we're using the ROM probability here, 60% and 40% chance. So you might argue, say, Mars, this probability look a lot similar to this probability here. Perhaps you're just lucky you'll get the correct option price. What if we try something completely different? 20% chance going up and an 80% chance going down. So this is dramatically different from the probability we used before, right? I mean, you can try it yourself. If you plug in 20-80% probability, and again, you solve for the C, you will get the correct price. The call option is $3.34. All right, so people figured this out in early 70s, and I think, well, if the probability is completely irrelevant for pricing call options, why don't we come up with a set of probability that would match the risk-neutral investor's preference so that the discounting rate would simply be the risk-free rate? I know it's a bit of a mouthful, but let me elaborate my point. First of all, let's go back to the traditional approach, right? Remember, the whole tedious calculation with traditional approach is we need to estimate the risk premium. Remember, the risk premium is omega times the share return minus the risk-free rate. So the omega is the tedious part that we need to re-estimate every single time, right? And remember, the reason why we have this whole risk premium is because in reality, all of the investors, most of the investors are risk averse. Risk averse means that if I invest in a risky asset, first of all, I need to be compensated by the risk-free rate of return, right? So that's the first component in the equation, risk-free return. Then we have an extra return that compensates for me as a risk-averse investor to step into this risky investment. Now, there's a second type of investor called risk-neutral investor. All right? So this is the equation that I mentioned. So as the risk-averse investor, first, I should be at least compensated by the risk-free rate. Then I want the extra bit of a return because I'm risk-averse. So that is the capital asset pricing model, right? And this is the model that we estimate the discounting rate for the call option. Basically, same analogy here. If I'm a risk-averse investor, first of all, I need to be compensated by the risk-free rate, and I need to be compensated with a bit of extra return here. Now it begs the question, if our investors are risk neutral, if they are risk neutral, which means they are indifferent between entering into a risk-free investment or entering into a risky investment. They are indifferent. So that's the whole definition behind risk neutral. Now, if you are a risk neutral investor, you only need to be compensated by the risk-free rate. Does that make sense? It doesn't make sense? So going back to Finance 101, you learned there's several types of investors. There's risk-averse investor, most investor who, afraid of risk, and they need to be compensated with extra return to enter into risky investments. That's first type, the most common type of investors. And there's risk-neutral investor who are indifferent between risky investment and risk-free investment. Because they are indifferent, they don't need extra return to compensate to enter into risky investment. And there's a third type called risk seeker, right? So they're seeking for risk. And they would demand less to enter into a risky investment because they get higher utilities from uncertain gambling. So that's three types of investors. And we figure out that the reason why the traditional approach is tedious is because we need to estimate this extra return that to compensate risk-averse investor. But then we figure out, the probability is completely irrelevant for the pricing of the call option. If that's the case, can we calculate a set of probabilities that will be consistent with risk-neutral investor preference so that we don't need to estimate this extra bit on the right-hand side? If we can do that, then we can argue the discounting rate is simply the risk-free rate. All right, see this? I just simply cross out the risk premium. Okay? So as I mentioned here, if investors are risk neutral, they don't need to demand extra return to compensate for bearing risk. So if that's the case, then our next task is to estimate so-called risk-neutral probability. Okay, so I'll give you guys 10 minutes break. Let's call it a break. Then we come back to discuss the risk-neutral probability. All right, 10 minutes break. All right, guys, so let's resume lecture. Sorry, before the lecture, we were talking about that if we understand, we work out a probability that is consistent with risk-neutral investors' preference, then we don't need to worry about estimating the risk premium. We can simply use the risk-free rate to discount the expected payoff from the call option, then we get a call option price, right? Now, so how do we work out this probability here? The whole idea with the risk-neutral probability is that if we have an asset that's growing at a risk-free rate and pay us the certain value ST in 1 year's time, then the probability involved has to be risk-neutral, right? So that probability has to be consistent with risk-free rate. And so we simply make the P star as the risk-neutral probability that this asset price going up, and 1 minus the P star is simply the risk-neutral probability of the asset pricing moving down. And by using some derivations, we can show that we will get the P star formula from this equation here. And you don't need to know how to derive the P star, but that's the starting point, right? So our starting point is we want to have the probability that consistent with risk-free rate. So then we can derive the P star is expressed by this equation here. All right, so that is the E, that's the E to the power of R times the delta T minus the proportion of decrease, then divided by the difference between U and D. We know what the risk-free rate is. Risk-free rate is 5%, and the delta T is 1 year, and that is the proportional decrease, and that's the difference between U and D. So we work out the risk-neutral probability of going up is 51.03. So 1 minus the P star give us the risk-neutral probability that the share price will go down. All right, so basically we work out the risk-neutral probability. And then we also know that if the share price go up to 13.50, then our call option would make a positive payoff of $6.50, right? And if the share price go down to $7.40, then the call option make a positive payoff of 40 cents. We then use the risk-neutral probability to work out the probability weighted average of that. Then that becomes our expected payoff on this call option. And because we are risk-neutral investors, so the required rate of return will simply be the risk-free rate, right? We can simply discount this payoff by using the risk-free rate. We discount it back 1 year, and below and hold, we get the same answer, $3.34. Okay? So that's the whole idea behind the risk-neutral valuation. First step, we step into this risk-neutral world. Then we pretend that we're risk-neutral investors. We work out risk-neutral probability. Then we work out the expected payoff of the call option. And because we're risk-neutral, we simply discount back using the risk-free rate. And in that sense, we don't have to worry about estimating the TDS omega and the TDS risk premium in the previous equation that I just showed you. Okay? So that is risk-neutral approach, simple and powerful. Yes, so that's basically what I mentioned, the problem with traditional approach and the reason why people don't use them. And one thing I want you guys to bear in mind is that although we are using risk-neutral valuation, I don't want you guys to think that in the real world, investors are risk-neutral. Investors are still risk-averse. It's just us knowing that the pricing call option has nothing to do with the underlying probability of going up and going down, and has nothing to do with the risk premium, so that we're going to take advantage of that and step into this risk-neutral world using the risk-free rate as the discounting rate. Okay? But I don't want you guys to think that investors are really risk-neutral. Okay, so what we have done before the break is we're using the one-step binomial tree. As I mentioned, if you want to have more accurate modeling of the underlying share price, we need to add more steps in the tree. So now let's level up the game. Let's using a multiple periods, using two-step in the binomial tree to price this call option. Okay? So again, the current share price is still $10, and we're going to value a European call option that has a strike price of 7 and expire in 12 months' time. But this time, we're going to set up two steps instead of one step. Basically, we're splitting this 12 months into two 6-month periods, right? So this time, the delta is 0.5. So the delta is expressed in a fraction of a year. So at the end of each period, the share price would either go up by 23.6% or you will go down by 19%. So this is the proportional increase and that is the proportional decrease. And we were told risk-free rate is 5%, continuously compounded. So here is our two-step tree. If we take the current share price, $10, and we multiply by the proportional increase, which is 1.236, we get a share price up here, $12.36. And then the way we get the next branch is by taking this share price, $12.36, multiplied by the proportional increase, 1.236, we get a share price finish here, $15.28, and we take this share price, $12.36, multiplied by the proportional decrease, 0.81, right? So the way we get 0.81 is 1 minus 19%, we get a share price of $10. Then you repeat the same process for this lower half branch. So you will get a complete tree. Does it make sense? The way how we get this tree is we take the share price, the current share price, we multiply by the little u, we multiply by little d, then we repeat the whole process for the final branch. Okay? And once we get the entire tree, and then we label the time schedule. So the first step is 6 months, so that's 0.5. And the second step, again, takes 6 months' time, another 0.5. All right, so a good habit to have is once you have drawn the entire tree, you want to write down the call option payoff at terminal point. So what do I mean by that? Right, so we know the terminal point is 3 outcomes. The share price can finish up here, $15.28. The share price can finish in the middle, $10. And if the share price takes 2 consecutive downturns going down and going down again, finish at a price of $6.56, that's the share price there, right? So those are the 3 terminal points. And then we understand the strike price of the call option is $7, right? Now, if the call option strike price is 7, then when the share price going up and up again, this call option would make a payoff of $8.28. So that's $15.28 minus 7. We get the payoff of $8.28. If the share price finished in the middle, this call option would make a payoff of $3, right? So that's simply the share price 10 minus the strike price 7. They give us the payoff $3. When the share price take 2 consecutive downturn, then the share price is $6.56. And $6.56 is lower than the strike, which means this call option finished out of money, right? Now, if the call option finished out of money, we would walk away from this out of money call and let it lapse with a value of 0. So once you get the entire tree, you write down the payoff at each terminal point. Then the next step is to calculate your risk-neutral probability, right? So we learned this formula in a previous slide. So the risk-free rate is 5%. And remember, the delta T here represents the time horizon for each step. A lot of people try to plug in the time to maturity of the option as the delta T. That is wrong. The delta T here is the time horizon on each step. So each step takes 6 months, 6 divided by 12,
so that's 0.5. And the proportional decrease is 0.81, and the denominator is the difference between U and D. So we work out the risk-neutral probability of the share price going up is 50.54. So 1 minus that gives us the probability the share price will go down, 49.46. Okay? And I'm going to demonstrate two methods. The first method is to work tediously at each branch of the tree. Then we get the present value. And the second method only can be applied to the European option. We're going to discount all of the payoff from the terminal point all the way back to the present. So I'm going to demonstrate two methods here. So the first method is to work backwards. We work from the terminal point backwards at each branch of the tree. Then we finally discount back to the present. Okay? So what do I mean by work backwards? What do I mean by work tediously at each branch of the tree? So first of all, let's start with the upper right branch. Now, in the upper right branch, I'm standing here. I know there's two outcomes can occur. If the share price increase to $15.28, the call option make a payoff of $8.28. Now, if the share price going down, that would make, going down to $10, that would make a payoff of $3. And we know what is the probability of that is going to happen. We have 50.54% chance the share price will go up, and there's 49.46% chance the share price will go down. So we have the risk-neutral probability, right? Now the expected payoff from this call option, so I'm standing here and I'm thinking 6 months from today, what will be the expected payoff of this call option? The expected payoff of this call option would simply be 50.54 times the payoff of the call option, $8.28, plus 49.46 times the payoff of the call option, $3. All right? So that would give us an expected payoff 6 months from today. But I'm standing here thinking that 6 months ahead, right? So the next thing I need to do is I need to discount that expected payoff from the terminal point back 6 months. Because we are using the risk-neutral probability here, we are stepping into this risk-neutral world, we can discount the expected payoff by using the risk-free rate, right? And we know what the risk-free rate is. Risk-free rate is simply 5%. And we only discount back one step. One step is 6 months. So that's minus 5% times 0.5. So that represents us using 5% risk-free rate, discount back 6 months. And that is your expected payoff. Now, if you do that, you will work out the value of the discounted value is 5.53. So once you work out this 5.53, you quickly write there, right? You replace this question mark with 5.53. That represents the discounted call option value in that point. Then we repeat the whole process again with the lower right branch. Okay, so we work backwards. We first focus on the upper right branch, then we focus on the lower right branch. So the same story. I'm standing here and I'm thinking 6 months from today, what are the two outcomes? We know there's 50.54% chance the share price will increase. That will increase to $10. If that's the case, my call option would make a payoff of $3. Alternatively, there's 49.46% chance the share price will go down. If the share price going down, that would go down to $6.56. If that's the case, my call option finish out of money, right? So if my call option finish out of money, that would make a payoff of 0. So I simply walk away from this worthless call option. And because we know the probability of that happening, we can work out the expected payoff of the call option in the lower right branch. right? So we simply take the probability weighted average of the two payoff value. Then I'm standing in this point in time and thinking, what would be the discounted value, right? We just work out the expected payoff at the terminal point. Then we're standing in this point in time, we're thinking, what would be the discounted value? Because we're in the risk-neutral world, we can simply discount the expected payoff back 6 months by using the 5% risk-free rate. If you do that, the discounted payoff is simply $1.48. Then we write down $1.48 in this branch here. Right? And finally, we are standing in the present. We're standing in time 0. And we're asking the same question. What would be the expected payoff of this call option 6 months from today? If the call option increased to $12.36, it would have a payoff of $5.53. How do we get $5.53? We discount it back from the upper right branch here, right? Now, if the share price going down to $8.10, how much is the payoff of this call option? $1.48, right? The way we get $1.48 is by discounting the expected payoff in the lower right branch. And then the next thing we need to do is we simply work out expected payoff 6 months from today, then discount back 6 months using the risk-free rate. We know the probability of going up and going down. We know the payoff in the up state. We know the payoff in the down state. And we discount back 6 months using the 5% risk-free rate. And we get the correct option price, $3.44. Okay? Again, we get the same answer, $3.44. So any question with the first method? We simply work tediously from the right to the left. And we repeat the same process at each branch of the tree. Does it make sense? And because yes? Yes. Yes. Yeah. As you divide the discrete period like into smaller intervals, that would approximate the continuous time. Yes. Yeah, you're absolutely right. So in the next week, when I introduce the Black-Scholes option pricing model, that model can only be used to price European options. Guys, remember, the famous Black-Scholes option pricing model cannot price American option. And the only way we can price the American option is by using the binomial tree, right? Binomial option approach. The reason is because, as he mentioned, that we need to divide the time to maturity into infinite intervals, and which means we have infinite branches. Then we try to ask ourselves whether or not to exercise this call option at each branch of the tree. So in that case, we can price the American call option because we can take all of the scenario into account, whereas the Black-Scholes option pricing model cannot do that. Okay, so that's the limitation with Black-Scholes option pricing model. And also one thing bear in mind, back in 70s or 80s, people like to use the Black-Scholes option pricing model is because their computation power is very limited, right? So the computer back in that time is quite limited. But with computation power nowadays, we can model a 10,000 step tree like in a split of a second because the computer is just so fast. So that is the advantage with the binomial option pricing model. And that's why you would see most of practitioners use this approach. Very good question. Thank you. All right. So I introduced the first method. Yes? Yes? Correct. It will be fixed for all branches of the tree. Yeah. Sorry. Let me have a look. Yeah, so that will be fixed for all branches of the tree. That's correct. Yeah. Any other questions? All right, so you might be thinking, well, the first methods take a lot of time. We work tediously from the right to the left, and also you would say, come on, this is a European option because this European nature, we know the occurrence of the cash flow. The occurrence of the cash flow would always be at a maturity date, at the terminal point. If it's so predictable, then we can simply discount all of the payoff back, within one go, right? Without doing at each branch. That is with European options. Okay, so if that's the case, I'm going to introduce something to you as the path probability. All right, so what do I mean by the path probability? So here we focus on the second method. Second method is the quicker method. We're going to discount the expected payoff from the terminal point back to the present within one step. All right, so if we think about this, how do we get this $15.28? We need to take two consecutive up and up to get $15.28, right? So the share price needs to go up and up again, we get $15.28. And how do we get this $10? There are two ways we can get this $10. The share price can first go up, then go down again. And alternatively, share price can go down, then go up again. So either way, we will end up with 10. And there's only one way we can end up with $6.56. How do we get $6.56? The share price has to go down, and the share price has to going down again. So the share price has to take two consecutive downturns to get $6.56. So let me summarize. The way we get $15.28, there's only one way up, which is up and up again, right? Two consecutive up. The way we get a $10 share price, there are two ways, going up again and going down, then going up. Two way, right? And there's only one way going down, which is two consecutive downturn. You have to go down, then going down again. Then you would end up with a share price of $6.56. Now, if that's the case, then we can take advantage of that because the path probability of getting up and up again is simply the up probability 50.54 times up probability 50.54, right? So that is simply the product of the two up probability. So that's up and up. That would give us a share price $15.28. So if the share price finished at $15.28 minus the strike price, that would give us the payoff of $8.28. All right? And as I mentioned, there are two ways we can get the $10 share price, which is going up and going down, and going down, then going up. And guess what? The path probability of getting the $10 is identical, right? So the up is 50.54 times the down, 49.46. If you're going down and going up again, it's the same, right? So it's 49.46 times 50.54. You have the same path probability. And then, as I mentioned before, there's only one way you can go down, which is going down, then going down again. That's simply 49.46 times 49.46. And that would lead to $6.56. So if that's the case, then our call option finish out of money. If it's out of money, then that's worth nothing. Right? So that's this probability times 0. So let me summarize what I said. One way up, up and up again, leads to a payoff of $8.28. And there's two ways that we can get $10 share price, going up or going down or going down or going up, but the path probability is the same. So we can simply use 2 times this product, then times the payoff when the share price finish at $10. So the payoff is 3. And there's only one way that the share price can go down, right? Which is going down and going down again. And that would lead us to a $0 payoff. All right? Now, that is the expected payoff at the terminal point. So that's 12 months from today. And remember, this time, we are not working at each branch of the tree. We are simply discounting this entire expected payoff all the way back 12 months. So instead of using 0.5, I'm using 1. So that's 5% risk-free rate times 1, and we get the share price is $3.44. Same answer as we got before. Okay, so that is with the European options. And what about the American option? The American option, we have no choice, but we have to tediously work backwards at each branch of the tree. The reason is because we are not sure when the holder of the option will exercise. All right? So because we don't know the exact timing of when the option will exercise, we have to pretend we are the holder of the option. Then we ask ourselves whether or not we want to exercise at that point in time. Then we work out what's the intrinsic value of the option and what is the discounted value. If the intrinsic value is larger than the discounted value, we're going to take the intrinsic value. All right, so just remember what I said. Then let's do one example with the American call option, with the American put option. Then we're going to do more examples in Thursday workshop. Okay? So here, this slide just says the Black-Scholes option pricing model cannot price American options, and binomial option pricing is the only way to go. Okay? And as I mentioned in the last week, the American call option should never be exercised early. Okay? So in that sense, we're just going to focus on the American put option because you can exercise the put option early. Right? So I explained that last week. All right, so what we're going to do is at each branch of the tree, we would always compare the discounted payoff with the intrinsic value of the put option. Basically, we are asking ourselves the question, should I wait longer or should I exercise the put today? Exercising the put today would lead to the intrinsic value of X minus ST. So the intrinsic value is simply the payoff of the put option at that time. Now, the second alternative is that if we wait longer, what we will get is the expected payoff on the put option, then we discount it back. We compare the discounted payoff versus the intrinsic value, then we make a decision of exercising today or wait for longer period. Does it make sense? Okay, so let's have a look at this question here. So the current share price is 40, and stock does not pay dividends. The risk-free rate is 10%, and we're going to have a two-step binomial tree, and each step takes 6 months. So in each branch of the tree, share price can either go up by 20%, or you will fall by 16.67%. Okay? And we were told the strike price of this American put option is 42. And we have 1 year to expiry. So that is all of the information. So again, we're going to draw the tree. So the first step is always to draw your binomial tree. Right, so the way we draw this tree is we take the current share price, 40, then times the proportional increase, which is 1.2. Then we get a share price of 48. All right? And then the way we get the share price down here is by taking the current share price 40, then multiply by the proportional decrease, 0.833, we get a share price of 33.33. Then you repeat the same process for the remaining branches. Okay? So you go home, do that yourself, and you will get the terminal price at each point. Then the next thing you should do, a good habit to have, is to quickly write down the payoff of this put option at each terminal price point. So remember, we have a strike price of 42, right? Now, if the share price end up being 57.60, should we exercise this put option? We have a put option with strike price of 42, right? If the share price end up being 57, shall we exercise this put option? No, right? So we don't exercise this put. The put finish out of money with a value of 0. Now, if the share price going up, then going down, or going down, then going up, the share price will finish with 40, right? So 40 is lower than 42. So exercising the put option would make a payoff of $2, right? So we write the payoff of the put option is $2 in the middle point. Now, if the share price going down, then going down again, share price finish with 27.78, then we have dip in the money put option, right? Because the share price is a lot lower than the strike price. And exercising the in the money put will lead to a payoff of $14.22, right? So I'm just simply writing down the payoff in this branch here. Okay, so what we're going to do is we're going to calculate the discounted value at each knot of the tree, which is same as before. Then there's one little extra step. The one little extra step is at each knot, we check whether or not the discounted value is less than the intrinsic value. The intrinsic value is the strike price minus the share price. Well, if the discounted value is less than the intrinsic, if the discounted value is less than the intrinsic value, then we would want to exercise the put option. Because if waiting longer, that would lead to a lower payoff. So we would want to exercise this put early. So if we exercise the put option, instead of writing the discounted payoff at each knot, we're going to write down the intrinsic value at each knot. All right, just bear that in mind. And you will see what I mean in 1 second. Okay, so after we draw in the tree, the second step is we're going to calculate risk-neutral probability, and we know how to do that. Risk-free rate is 10%, and each time step is 6 months, right? The proportional decrease is 0.833, and denominator is the difference between the U and the D. So we get a probability of 59.44. So that's the probability of going up. And 1 minus that, we get the probability of going down is 40.56. So again, we're going to start with the upper right branch. So we're standing in this point, we're standing in this knot, and we're thinking, what would be the expected payoff of this put option 6 months from today? All right? So same story as before. Now, if the share price is going up to $57, $60, we have out of money put, right? The put option finished out of money with a value of 0. And we know the probability of share price going up is 59.44. And there is 40.56% chance the share price will go down. If the share price goes down to $40, then we have an in-the-money put option, and exercising the put option will lead to a payoff of $2, right? So what is the expected payoff? The expected payoff is simply the probability weighted average of these two payoff. So that's 59.44 times 0 plus 40.56 times $2. And again, because I'm standing in this point, I'm thinking 6 months ahead, right? So I'm just going to discount this back 6 months using the risk-free rate, 10%. Discount back 6 months, so that's 0.5 here. And we get the discounted value is 77 cents, right? 77 cents. Now, before writing down the 77 cents in this knot, we need to ask ourselves, what is the intrinsic value of the put option? What do I mean by that? Basically, you ask yourself, how much I will gain if I exercise this put option today? So the put option, exercising the put option today would lead to nothing, right? Because in this knot, the share price is 48. Remember, 48 is lower than the strike price, 42. In other words, you would not want to exercise this put option at this knot, because exercising the put option at this point will lead to a loss. So the decision is not to exercise, and by waiting longer, if you hold on to this put option, the expected payoff of the put option, discounted expected payoff of the put option is 77 cents. So waiting longer will give you a higher value. All right? So what it will do is you write down the higher value, 77 cents. Then what we do next is we're going to repeat the same process with the lower right branch. All right? So we're standing in this point, and we're thinking, how much this put option is worth if the share price is going up? Well, if the share price is going up to $40, then this put option will make a payoff of $2. Now, if the share price is going down to $27.78, then this put option would make a payoff of $14.22. We know the probability of going up and going down, and we take a probability weighted average, we can work out the expected payoff from this put option, right? Then what we do is we discount back, because we're standing at this point thinking 6 months ahead, so we discount back 6 months by using the risk-free rate, and we get the discounted value is $6.62. Now, before you write down $6.62 in this knot, we need to do one more extra step. That is checking, shall we exercise this put option today? How do we check that? We simply check the intrinsic value by taking the strike price minus the share price at this knot. The share price is 33 cents. So 42 minus 33.33, that's $8.67. Which means by exercising this put option today, I will have a higher value compared to holding on this put option for another 6 months. So the decision here is that I should not wait. I should exercise this put option immediately and take that $8.67 in my pocket, right? Because waiting longer, holding on this put option longer, will only lead to a lower value, $6.62. So I don't write down this value. I write down this intrinsic value, $8.67. So that's precisely what I did. I wrote down $8.67 in this knot. Okay? Then that leads to the last step, which is to discount everything back to the present. Now we know there's 49.44 chance the share price will go up. If we go up to $48, the discounted payoff of the put option is 77 cents. Now, there is 40.56% chance the share price will go down. If you go down to 33.33, that would lead to a payoff of $8.67, right? And we know the probability of that happening, so we work out expect payoff, then we discount back using the risk-free rate, 10%. Right? We discount back 6 months, and we get the put option price is $3.78. Does it make sense? So let me summarize. The way we value the American put is same as we value the European option. There's just one extra step. After discounting the expected payoff at each branch of the tree, you need to compare the discounted value with the intrinsic value. The intrinsic value is the value if you exercise the put option today. Then you compare the two values, then you take the higher value. All right? Then you take the higher value, you write down in that knot, then you're using that as the input for the next step. which is to discount back to the present. Okay? So I think the rest is pretty easy. And that will be all for this lecture. Thank you.